Thought Leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Today's episode continues our SEC series with a discussion of non-GAAP measures, the top comment letter area in 2025. Non-GAAP measures are widely used by companies to supplement their financial statements and help investors better understand performance and financial condition. Given their prominence, it's no surprise non-GAAP has been a consistent focus for the SEC staff in recent years, and we expect that to continue. In this episode, we cover the most common SEC comments related to non-GAAP and offer advice to help preparers stay ahead. Joining us are Kevin Vaughn, a partner, and John Lee, a managing director in PwC's National Office. They both sat down with today's guest host, Kyle Moffitt, PwC's professional practice leader. Kevin and Kyle both spent nearly 2 decades at the SEC, so they bring valuable insight from both sides of the table. With that, let's tune in to their conversation.
Thank you both for joining me. Really appreciate you taking the time. John, I worked closely with you in the national office for a number of years, and I know in your role as managing director, you spent a lot of time, obviously answering questions from clients, dealing a lot with comment letters specifically related to non-GAAP financial measures. Kevin, great having you. You spent a lot of time at the SEC, so you have a very unique perspective. You used to issue these comments while at the staff. I'm sure that some of our audience, our listeners, have been on the receiving end of the comments that you've issued to them with respect to non-GAAP measures. But obviously, you tend to spend a lot of time with clients as well. I understand that one of our clients has called you the non-GAAP sensei. So I'm not sure non-GAAP sensei, non-GAAP ninja. I like both.
Both work.
But I think it highlights, both of you obviously have an incredible amount of useful insights to share today with me. So, John, as I think about just, some of the work that we're doing, the tracking of comment letters, we'll get to that when I think it's very insightful to share that. But Kevin, I want you to kick things off just kind of a high level, talk a little bit about just what we're seeing with respect to non-GAAP.
Yeah. So, I think the biggest thing is it continues to be very much a focus point for companies. It's part of how they tell their story. And so we see it's over 95% of the largest companies of the S&P 500 will use some sort of non-GAAP measure, either in their quarterly reports, annual reports, earnings releases, et cetera. So it's a good way for companies to communicate. Of course, we love GAAP. GAAP is great, and it provides a nice, consistent framework for companies to use. But sometimes there can be more to the story. So I think companies look to use non-GAAP measures just to help them tell their story and adjust out maybe items that are not necessarily reflective of their core operations in a given period, and to supplement that GAAP discussion. So that's, I think, certainly why we see it, over and over. Companies always thinking about evolution of those measures as well, and so it's certainly timely always to have these discussions.
Yeah. As I think about kind of the non-GAAP and just setting the stage, obviously, like as you said, it is how management tells a story. And I think years ago, it used to be that you were presenting non-GAAP measures because, hey, you had a one-time event, you wanted to show period over period changes so an investor could understand, like, okay, here's what's happened this period versus last period. And oftentimes people would say, well, we're kind of normalizing it, or we're adjusting it for the effect of this one-time event. Obviously, it's evolved into standard practice for companies to obviously share their story. So as I think about it, let's give the audience kind of, John, have you talk a little bit about what do we mean by non-GAAP measure?
Right. Yep. So first of all, thanks for having us. As Kevin was saying, non-GAAP measures are very prominent, pun intended. So like you were saying, 95% of companies or more use that, and it's an important tool, as Kevin was saying, for management to describe the operations of the business, their core operations, right? So when we think about a non-GAAP measure, we start with a GAAP measure, and you start adding and subtracting things from that GAAP measure that are also GAAP. And the more things you add or subtract, you get to eventually what we call a non-GAAP measure, right? That base GAAP measure is important, and we'll talk about that later. That's the directly comparable GAAP measure that eventually that non-GAAP measure needs to be reconciled to. And the non-GAAP measure, and we'll talk a little bit about this later, is different than, say, a key performance indicator. Similar rules, similar guidance, but it's kind of different name for a KPI. Think like comparable store sales or things like that, which is not a non-GAAP measure. So we'll get into that a little bit. But when we think about non-GAAP measures in general, the staff really pays attention to that because they want to prevent those non-GAAP measures from being misleading. So again, the management is telling the story about their business, their company. They want to give maybe a rosy picture about their company, but the staff wants to prevent a rosier picture than maybe is needed for that particular non-GAAP measure when they're talking about their company, right? And there's not necessarily a definition when it comes to misleading, right? That's in the eye of the beholder, really. The staff,
in the eye of the SEC, the eye of the SEC staff. Yeah,
exactly. So we'll talk a little bit more why that's important, why the staff picks on that, right? And the judgment that's involved with that. But that's why the staff also has a lot of guidance out there as to what's in the fairway for what's an appropriate non-GAAP measure or the adjustments that you're making, right? So.
Yeah. Well, I think that's a good segue then into kind of some of the numbers behind the trends and what we're seeing. And John, I know, I always would talk to you about what are we seeing, what are our trends, and it's something that you've always been monitoring the comment letters, and certainly the length of time. I think how long? 6 years in an SEC service. There's the SEC and Capital Markets team. Any changes to the overall trends in those figures, kind of that we're seeing from year to year?
Yeah, so non-GAAP measures is consistently the top trend when we're taking a look at comment letter trends in general. It's across all sectors except for maybe one. I think health industry, it's number two. So the staff's obviously paying attention to that. When we are tracking numbers, and we've done it for a number of different years, right, Kyle? We're always taking a look at maybe the 12 trailing months as of 9/30. So just to give some context for the audience. And we're only looking at comments for those non-GAAP measures that are in Qs and Ks. So obviously non-GAAP measures can be presented in a number of different filings beyond that, but just to give some context to the numbers that we're about to talk about. So if we take a look maybe a couple years ago, we saw of the comments that were given, about 350 or so comments were related to non-GAAP measures. That's declined over the last couple of years to around 220 or so non-GAAP comments within particular letters. So Kevin will speak to maybe some of the reasons why we may be seeing those numbers come down a little bit. But when we're taking a look at the specific types of comments that are being provided around non-GAAP measures, we bucket those into different categories as well, so we can get a better understanding as to what the staff's focusing on. So the most common comment that we see are when the staff's picking on or talking about what are the specific types of adjustments that a company is making within their non-GAAP measure. Second, we see the staff talking about how is a company labeling, or if they're even identifying those non-GAAP measures within the filing appropriately, and because there's required disclosures that go around with that to make sure that the investor or the reader knows about that. Third bucket we see most often is when a registrant may give undue prominence to a non-GAAP measure as opposed to the directly comparable GAAP measure. And finally, kind of a more distant fourth is individually tailored accounting principles, right? So when we take a look at those particular buckets in generally, like I said, the specific adjustments within a non-GAAP measure is something the staff tends to focus on more often than not. We actually have seen that come down year over year. Last year was about 40% of comments. This year, we're seeing about 30% of comments, and then it's an uptick really on the labeling of a non-GAAP measure and identification, and then also undue prominence. So still the same ordering, but a little bit of a shift in the makeup.
Yeah, and I think, naturally, I think the question, as you alluded to, John, is well, what's driving this, right? Obviously, we had a change in administration, but before we jump too much and say that it's that necessarily, because keep in mind that as you mentioned, it's a trailing 12 months. So, and it's based on when the comment letters are released. And so we've kind of got a split, right? We've got a few months of the new administration and a few months of the old administration. And so maybe that's not the key driver as much as I was thinking through some of the factors. Well, one of the biggest ones is 2022 was the last time. December of 22 is when we had the last update of the compliance and disclosure interpretations, which are kind of the staff's views and where where they lay out kind of how they call balls and strikes on this.
Mm-hmm.
And so that was December of 2022. And even when they released those, they kind of said, hey, these updates are based on our recent experience. So if you think of the timeline, the staff reviews every public company once every 3 years. So essentially, coming into 2025, every public company, or probably nearly every public company, has been through one review with kind of those updates in mind, either in the preceding months right before it or post those updates. So you kind of have this churn, right? We saw it after Sarbanes-Oxley. Initially, when companies were picked up, we'd see a lot of comments, and then just over time it declined because the staff was looking at it more frequently. And then I think, also naturally when that happens, we've been doing this podcast for many years. We've got the publication that John has played such a key role in as well, where we talk about the non-GAAP measures. There's a lot of discussion in the marketplace about this. As you mentioned, like we get phone calls all the time about, okay, how do we think about the staff's guidance on this? Like, how do we think about these particular adjustments? So I think companies are changing their behaviors as well, responding to the comments, and then maybe I think those are probably the biggest reasons. There can be some timing things like associated with when they release comment letters. We did see kind of over the summer that there was maybe some that were taking a little bit longer to get released. Certainly as you led up to the shutdown, the staff may have been focused on other things, preparing for the shutdown. And so for the potential of a shutdown. And so maybe they weren't necessarily as focused on getting those comment letters out the last couple of weeks of September. And obviously since September, they've been shut down in October and into November here. So they haven't been releasing anything new anyway. So kind of all those things. We'll talk maybe a little bit more about the administration and how that might change as well. And it may be starting to play a little bit of a role, but I think those other factors might be the bigger drivers.
Yeah, I guess one kind of observation / maybe question for both of you on that. When we talk about the staff's CDIs, right? These are compliance and disclosure interpretations that are, the staff's views or positions on non-GAAP. And I think a lot of people, in the past have said, well, they're interpretations or they're staff positions. This, they're not grounded in a rule. But I think, I'd say that, look, if the staff has published CDIs, it's positions they have taken, it's likely they're not going to back off of those positions unless you see them, rescinding one of the CDIs. So I guess my question for you is, have we seen the staff basically say, yeah, turned a blind eye to it if, hey, look, it's just, have companies responded and said, well, this is just a staff interpretation. We don't need to comply with it. I mean, I think in my experience has always been, look, the staff is going to point to that and say, this is the guidance. This is our expectations, fix it. But I guess, is that the same experience you guys have had?
Yeah, I think so. I mean, I will say, like, the staff approaches these, each one is specific to the company's specific facts and circumstances. So they're very methodical, I would say, in terms of how they approach the issues. And so they're always willing to listen to the perspectives of the company. And so there is no, not necessarily automatically, like if you're adjusting for this item, it's always prohibited. But they may go into it saying, hey, we've objected to this adjustment in other situations. So maybe somewhat thinking about that, and it would be a pretty high hurdle to overcome. Yeah. But we don't see comments. We certainly don't see comments where the first round of the comment is, "Hey, you're adjusting for this. Like, we object to that. Take it out." It's always, as we've talked about probably in the other podcasts on this too. Like, it's a discussion. It's a dialogue that the staff is entering into on that. So
well, that's I think kind of leads me to the next point, and you kind of. You mentioned this, Kevin, and John, as you walking us through kind of the 4 categories of adjustments or not adjustments, but comments, categories of comments that we're seeing. And one of them that stood out to me, and I wanted to interrupt and ask questions, and I realized, okay, I have questions later on to ask you about it. But it really is kind of the one that I always highlight, which is the first one is the specific adjustments within a non-GAAP measure. I know that's an area that I always focused on. You see that a lot, and that's where companies can get sideways. So can you kind of talk through some of where those categories for us and what we mean by those when you mention them?
Yep. So So the first category that we talked about, right, was, to your point, the specific adjustments that are being made in a non-GAAP measure. That one, as Kevin mentioned a few years ago, the staff did issue new C&DIs. One was in specific regard to the types of adjustments, right? Within that C&DI, the staff really focused on making sure that the adjustments that are being made by a company in their non-GAAP measure is reflective of non-recurring items within the context of what is a normal recurring expense for that company, right? Mm-hmm. Within the context of their revenue generating activities, what is their business plan, their growth plan, et cetera. So the reason why, and we'll talk a little bit about this in a little bit, but that one is a little bit more judgmental, right? The facts and circumstances for one company are definitely different than the fact pattern for maybe a different company within industries and whatnot. So the staff has more room to ask questions around that. To Kevin's point, the staff asking questions is maybe just probing and making sure they better appreciate that and not necessarily objecting to that. But again, from an adjustments perspective, the staff wants to make sure that the adjustments being made are not misleading, that you're not excluding something that actually is going to recur for that company going forward, and you're not being biased within that particular non-GAAP measure, right? So the next category, we talked about was the labeling and the identification of a non-GAAP measure. That's very simply, hey, if you have a non-GAAP measure in your filing, have you appropriately identified it as such? And do you have the right disclosures around that, right? So anywhere from making sure management has discussed why it's important to them, providing the reconciliation, the basic tenets, right, of a non-GAAP measure and the disclosures that go around that, and then specific labels around that non-GAAP measure too. They want to make sure the label that you're using doesn't confuse a reader, so where they think that is actually a GAAP measure, it's distinct enough, they understand it's an adjusted measure and whatnot. So, and making sure they pay attention to that. The third item is the undue prominence, and that could show up in a couple different ways. The most common is maybe every time you present a non-GAAP measure, you want to make sure you disclose the directly comparable GAAP measure. When you're doing your reconciliations between the two measures, you're making sure that you start with the GAAP measure. Overall, just making sure that a reader doesn't forget that the non-GAAP measure is an adjusted measure. There is a comparable GAAP measure, and you're paying attention to that. And then also, when you're talking about your business and MD&A or otherwise, that you're not talking to the non-GAAP measure more so than you would your GAAP measures and what's required by GAAP, right? Mm-hmm. And then last, that fourth bucket that we were talking about is the individually tailored accounting principles. And that's very simply making sure that a reader, obviously GAAP is out there. To Kevin's point, we love GAAP, right? We want to make sure that we represent that appropriately. But
this is the first time I've heard we love GAAP 2 times in a podcast, but now you've heard it 3 times.
I think we're gonna have bumper stickers. We love GAAP
T-shirts, yeah.
But making sure, like, obviously, we're under accrual basis of accounting for GAAP. You're not having a measure that's cash basis.
Yeah.
A very simple example, right? So paying attention to that as you're doing certain adjustments. So.
No, I think those are all good points. As I think about the specific adjustments, in my mind, I do think of things that tend to get people in trouble are internal payroll costs, right? That maybe it's presented in a line item in the income statement, like restructuring charges or some other line item, and then you just simply adjust that line item. Well, the staff wants to know what's in that line item. They want to peel it back and understand those expenses, and oftentimes may object to a particular expense within that line item, financial statement line item, being adjusted out. So I think that's something to keep in mind with respect to that.
I think a lot of times, right, like the starting point for the comment might just be like, we don't know. You've got some general description of an item, and so we don't even know what's in there. So tell us what the first comment is. Just tell us what's in there, and then you give that detail, right? So we'll get into tips to avoid comments, things like that. Yeah. But yeah, I mean, certainly we see a number of comments that start that way and then go down that path of well, now we're going to break down each of those components and want more detail of whether that's part of your recurring operating expenses.
No, I think it's a great point. And, thinking about like the labeling, right? We've seen, I've seen that quite often where it does, like somebody might say, oh, this is some sort of cash flow, operating cash flow measure. But then you take a closer look and you're like, well, this is actually free cash flows or adjusted free cash flows. Let's be clear about what it is, that it isn't it's not the GAAP, it's the non-GAAP. So the title needs to be reflective of that non-GAAP measure and not confused with anything else. I think billing, sales, those types of things, like, hey, don't call something revenue or sales if it truly is not the GAAP definition of revenue or sales. And we've seen that often as well. So that kind of gets me to, as I look to think about the data, why do we think the buckets you noted, John, are the most common? I mean, obviously the adjustment piece, but provide some insights on that for me.
Yeah, I think, and this is not, I don't think, unique to non-GAAP measures. I think any time you have an area where there is judgment or estimation involved, there just leaves more room for the staff to ask more questions around that. To Kevin's point, part of it is making sure they understand how companies approach that. And because it's an estimate, there's room to probe and ask questions around that. So like we talked about earlier, the staff's goal is to make sure that a non-GAAP measure is not misleading. There's not a specific definition on that. There's maybe a fair way. And to your point, Kyle, earlier, it's in the eye of the SEC as kind of what they do and do not think is misleading. But because of that, again, what could be acceptable for one company because of their facts and circumstances, their business plan, their revenue generating activities may not be the same for others. And that can be frustrating at times, maybe for companies.
And companies want to point to the other company, and they frequently call them out and say, well, X company does this and you guys let them do it. I know you and I've heard that multiple times, and I'm sure you, John, have heard that on calls with companies as well.
Yeah. Our clients and our engagement teams that we work with can always find an example of something else. And we always have to remind them it could be a little bit different between company A and company B, right? So again, that just leaves room for the staff to ask more questions around that. But
yeah, and I think too, like sometimes what we see and maybe like as you think about this, like we've talked about some of the basic things like the labeling and the prominence, like making sure you have the disclosures. I think when I have conversations sometimes, and Kyle, I don't know if you did this. I'll admit, like this definitely happened when I was at the staff.
If it was something stupid, then I never did it.
Yeah. All right. But like you pick up the filing and you might be like, I'm really on the fence about, I want to ask a question on this non-GAAP? Like I kind of think I understand it. Like maybe I don't want to, but then you keep flipping through and you see that they've like got, a non-GAAP measure labeled as if it's, a GAAP measure, right? Or they just completely missed putting the reconciliation in there. And so then you kind of pick it up and you're like, okay, so I'm going to issue the comment on those because those are kind of clear cut. Like, hey, you've got to put this in there. And you know what? While I'm at it, I'm going to go ahead and issue. I was on the fence, but now I'm going to issue the comment asking more questions. Probably all of our former directors and deputy directors and probably are cringing if they hear this, because it's maybe not the way that it was supposed to work. But certainly I think that factors in. So I always tell companies like
Kevin has a fan club.
Get it?
People are listening. He's got tons of fans out there.
Yeah, I'm pretty sure they're not listening. But making sure you get like those basic, the basic requirements, get those right, so that you don't open the door for those type of things.
Yeah. Those are great points. I mean, look, I definitely am kind of in the same boat as you. I mean, definitely run into those and situations when I was the staff and, obviously, I think to your earlier point about what will this new administration be focused on, right? Like, over the years, the pendulum certainly has swung, and it does swing when politics are involved, and there's different leadership, right? We're in the Trump administration with Chairman Paul Atkins as the head of the agency, who's going to be focused on a lot of different things than maybe the previous administration. So, now that we are several months in, I mean, have we noticed any changes, or do we expect to see changes? What do you think there?
Yeah, I mean, I think so far, I'm reluctant to say that we've seen any notable changes or to attribute any of those changes. Like we talked earlier about some of the other factors at play. Certainly we've both lived through it in terms of a change in administration. There is a period when you're on the staff and you're like, okay, well, I don't really know. And so before, like you had, maybe under Gensler, you had a full charge of like issue these comments, and you knew that you had the backing of the senior leadership and the commission in terms of issuing those comments. And so now there may be some uncertainty. So there may be some people that are, hey, like let's just kind of like, unless there's something egregious, maybe we're going to pull back and wait and see what happens. But we do still see a number of comments coming through. So it's not, I think John said 220, right? Like that's not a small number of comments. That's still a pretty significant number. So we'll see. I mean, this has not been, there's been other items that Atkins has talked a lot about. He hasn't necessarily talked about non-GAAP. We do have the new Corp Fin director that's in there. So we'll see kind of, what his focus is. That's Jim Maloney. And so we'll see like what the priority there is. And it could be that they just continue down the same path in terms of how they focus on it. We've talked about, they could take a fresh look at some of the C&DIs and make sure that they feel like those are still fit for purpose, that still represents the views that they want to do. And then of course we could see a shift. This came into the SEC's rules, as part of Sarbanes-Oxley, so it's over 20 years old. Is there an opportunity to revisit some of that? Certainly, we've got on the agenda for the SEC this rationalization of disclosure practices, thinking about, could there be something in there from a non-GAAP perspective? I think those are all kind of on the table. So that's probably like that sets the table of what there is. And then maybe if I go into a little bit of like my own personal prediction, if anybody's interested in that,
I am. Go ahead.
It is mine. I do think that they will probably revisit their approach on this. I think a lot of the C&DIs that have come up over the years, right? They've talked about them. They talk about things that could be misleading. So I think that they might take a look at those and maybe they could codify some aspects of that. But also, this administration under Atkins, they've already kind of signaled this perspective of letting companies and investors figure some of these things out on their own and not having the regulator step in. So I could definitely see some sort of shift happening. I don't know that I would say that that's happened yet. We'll see with the new Corp Fin director coming in.
Yeah, I think as I think about that, like there's always two pieces to this that I always point out to companies. The first of which is, to your point, like when you're presenting non-GAAP, if there's something questionable, you run the risk of comment letter from the SEC and potentially having to change, and that can be sometimes painful if the analysts in the street are expecting to see a non-GAAP measure with an adjustment, and then you're no longer allowed to do it. You got to make that change, and the messaging that can be challenging. The second piece is as I think about the enforcement, right, and we've seen some enforcement actions against the SEC. I mean, the SEC's brought against companies, and there have been some, a couple of them that have settled. And I think those are, as I think about the comments and then, of course, the enforcement actions, I think it's a good segue into, all right, assuming there's not a significant change in their approach, or that it's going to take time, people are going to be thinking and should be preparing for this 10K season as they're thinking about their non-GAAP measures for year-end filings. So John, can you talk a little bit about any advice you have for the audience?
Yeah, maybe not to oversimplify it, but part of it is understanding what the rules are, right, and the interpretations that are put out there by the staff. We talked a lot about the judgment areas when it comes to a non-GAAP measure, but Kevin spoke to some of the blocking and tackling when it comes to a non-GAAP measure as well, right? Having the right disclosures, being thoughtful and fulsome in your disclosures to make sure that the reader, including the staff, has a really good understanding as to what's going into that non-GAAP measure. I think when there's ambiguity or less transparency, that's where there's room for questions. And not to say they disagree, but they're just trying to figure out what is in that adjustment or that non-GAAP measure to, again, make sure that it's not misleading. And that all stems from, I think, on the front end, a company really understanding their process, having the right controls and processes in place,
a great point.
Right?
Yeah.
To make sure that soup to nuts, they're being thoughtful and thinking through, why am I making this adjustment? Do I have good legs to stand on when it comes from the interpretations that if it does come under scrutiny, I have a thoughtful explanation to whoever's asking the question, and just making sure that from management all the way up to audit committees and others are on the same page as to what's going into that non-GAAP measure, right?
So, John, to stick with you here. Okay, so you've laid out kind of the things to think about, right? What advice would you give to companies if they need to respond to the staff, like some best practices?
Sure. So, yeah, we've hit on a couple of these different items, but one is don't assume the staff is objecting, right? Don't take offense to the question. When you're responding, make sure you're responsive to the question. You're taking it seriously. You're being thoughtful, being fulsome in your response. And then it always helps if you provide a revised disclosure or say, hey, this is how I think I can help resolve the question, putting some additional disclosure in there, making this tweak, whatever it may be, just being responsive to the overall comment, I think. So
yeah, and I would maybe layering in and piling on that a little bit, like, and it seems basic, but we've seen people not take this approach. Just take the comment seriously, right? Like we've seen companies that when we look through comment letters and responses, where you can kind of see like it almost feels like maybe they didn't put their full and best effort into that first response, and then that can send you down a path that may be more difficult. So I mean that's advice right across all of these podcasts, I'm sure, but certainly, and to the point about disclosures, think about if there's something that you can offer up, right? Like think about, there's a reason the staff asked the question. There was something about your disclosures that raised the question. So try to put yourself in their shoes and think about, okay, like, is there more clarity we can offer? Like the basic example where maybe the description of the adjustment just wasn't really clear. And so the staff had to ask, well, what is in here? Okay, well, we're going to offer up to you that we're going to revise these disclosures to add that clarity. The staff has said disclosures can't overcome a misleading non-GAAP measure, but in those types of situations, they've been very receptive to kind of working with companies and thinking about how to enhance those disclosures.
Yeah, no, I think all great points, and I'd say, one of the things we talked about as a collective before was whether we would, even approach the situation where the staff decides to object. And I know that we could spend 5-10 minutes talking about the what ifs. If the staff objects, how do you think about it? What do you do, kind of thing. I think my best advice is you definitely need to pull in all the right parties to have the conversation, right? And that means, legal counsel, securities counsel. It means, audit firms for their insights, national office folks. But then also even having a phone call with the staff to understand where they want you to be at the end of the day.
Yeah, and that's been clear, right? Especially in my view, it's always been the case. You could always call the staff; they're always receptive to those conversations. But I think they've been very vocal about that in this administration. That openness to those conversations, they're very, very willing to talk through those things.
So earlier, John, you had mentioned a little bit of KPIs, and obviously the big point there is that KPIs are not non-GAAP measures. But Kevin, sticking with you, anything that our audience should be thinking about there with respect to KPIs, disclosure, any considerations? Yeah,
I mean, I think the key thing is like you've got to figure out what it is first. So make sure when you're thinking about something, do the assessment, think about, is it adjusting, adding or excluding items from a GAAP measure, right? Then you're going to be in the non-GAAP territory. Key performance indicators, they may have like a financial aspect to them, and there may be a GAAP component to it, right? Like comparable store sales as an example, right? You're taking, a GAAP revenue type figure, but there's other factors at play. You're not like excluding items as you would in a non-GAAP measure. So make sure you figure out the right framework because that will dictate what your disclosures are. The disclosures for KPIs are very similar in terms of some of the narrative. Explain how you calculate the KPI, explain why you think it's useful, how management uses the measure, et cetera. And there is commission guidance. You don't have to necessarily do the same reconciliations. You certainly can if it's helpful, if it provides good context. Just make sure you don't accidentally put a non-GAAP measure in there when you do that reconciliation. We've certainly seen that. Yep. And so, if you're looking for the specific guidance on that, I think we talk about this a lot because it doesn't actually say SEC's KPI guidance. It's actually the SEC's guidance on management's discussion and analysis of financial condition and results of operations. So, I think if you do a Google search and say KPI SEC, it should pop up somewhere in there. But it was a commission release from a few years ago that kind of talks through. Yeah, you did.
I worked on that
right before you left.
Yep. A lot of great insights in there.
It was beautiful. It was very
great piece.
very quick, very concise.
All right. Well, guys, any final thoughts before we close out?
Yeah, no, I the one last thing, I kind of hinted to it as well. Obviously, we sit here on November 11th as we're recording this. The government shut down. Maybe there's hope that it's not going to be the case, but we do have the new Corp Fin director in there. We've got, we call it conference season coming up next month, the big AICPA conference. Generally, we expect there will be SEC staff members there as long as the shutdown isn't still going on. And so it'll be really interesting to get some insights from them. I think that'll really be the first chance for the new leadership of Corp Fin to share their insights and share how they think about things like non-GAAP. And so pay attention there. I'll put in a plug. We always do a publication after that. Any good insights on any of the comment letter topics, right? But specifically non-GAAP, I think we'll be listening closely and make sure that we put that out there as well.
All right. Well, with that, I want to thank both of you for joining, and looking forward to future podcasts with the two of you. Thank you.
Right. Thank you very much.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.